Okay, good evening, guys. So date is Wednesday evening on April 30th. This will be a Watchhimtrade.com webinar in which I answer questions submitted by you guys. So let's get to it. First question I received was, when would you go in the money on options versus out of the money on options? Great question. So there's a couple sides to this that we need to go over, a couple steps to walk through. First of all is we need to understand that in the money options have less premium and out of the money options have more premium. Therefore, the key is being able to identify when it makes sense to be willing to pay more in premium and when it doesn't make sense, when you only want to pay little in premium. And what that comes down to is the likelihood of a big move being made. If there is a good chance a big move gets made, then out of the money options, if there is not a good chance a big move gets made, then out of the money options are not going to perform as well as in the money options. If there is a good chance a big move gets made, though, then out of the money options will perform better than in the money options as those out of the money options get closer to in the money and in some cases go in the money themselves. So the simplistic answer is you want to play in the money when there isn't a good chance of a big move being made, and you want to be out of the money when there is a good chance of a big move being made. So that's all well and good. But now this leads to a natural second question. Well, how do you determine that there is a good chance of a big move being made versus there isn't a good chance of a big move being made? Because that's really what it comes down to when we're trying to determine should we be in the money or out of the money. So with that, there are three main things I look for. Speed, number one, range, number two, and extension, number three. Speed. How fast is the tape moving? All these tapes you see right here, it's after hours, so they're not moving at all. But during market hours, these are all moving. There's always orders going through. How many orders are going through each second? Am I able to count a couple seconds in between orders, or is there tons of orders going through on every second? The tapes are moving very, very, very fast. All right. Then also, what about the level 2? Is the level 2 moving fast or is the level 2 moving slow? Are the bids really racing higher? Are the asks really crashing lower? Or is it just kind of jumping around, slow and steady type movement? If the tape is fast and the level 2 action is fast, then I believe there is a better chance of a big move. If the tape is slow and the level 2 is slow, then I don't believe there's a good chance of a big move being made. If you want to see what I'm talking about, in real time, all you need to do is look at the film, the live trading sessions from today and yesterday, which will be uploaded to the site, and compare them to the live trading sessions from last Thursday and last Friday. Last Thursday and Friday had very fast tapes, very fast level 2 movement. Yesterday and today, very slow tapes, very slow level 2 movement. All right, so that's number one relative to speed. Number two, range. What does the daily range look like at the outset of the day? Is the stock moving in a very tight range through the first 10 minutes, 20 minutes, 30 minutes of the day, or has there already been a decent move made within the first 10, 20, 30 minutes of the day? Moreover, is the stock showing you a move pre-market? Is there volatility pre-market? Is there a good range pre-market? Is it up 1%, down 1%, or is it pretty much flat? Again, the last 2 days, my primary stocks have been relatively flat. Last Thursday, Friday, a lot of these stocks were sitting on percentage gains or losses of at least 1% in either direction. In my experience, I feel that when a stock is able to show good range early on in the day, it has a better chance of continuing that range throughout the day versus when it is in a tight range early on in the day, then it's more likely to be that way the entire day. Let's look at some examples here relative to range. So starting off, I want to show you Amazon from last Friday and then on Monday and compare it to yesterday and Tuesday. So number one, what I want to show you, okay, is the daily chart on Amazon. You look at these last 4 days here, a great contrast in daily range. You look at Friday and Monday, and then you compare it to today and yesterday, and you can see Thursday you traded in a range of 316 on the high, 302 on the low. That's a 14-point range. Then on Monday you traded 304 on the high, 288 on the low. That's a 16-point range. So those 2 days, Friday and Monday, averaged a 15-point range. Great range action. Then on Tuesday, you had 301.80 on the high and 290.45 on the low. So you had about an 11-point range. Then today, you had 304.50 on the high, 298 on the low for a 6-point range. So the range much, much smaller yesterday and then especially today compared to Friday and Monday. And if you dig a little deeper and look at the intraday chart, you'll see that there were signs of that very, very early on in the day. Friday, real wide range type of day, right? Well, look at the first 6 minutes of the day. You're looking at a 3-minute chart. This is last Friday's price action on Amazon. You can see the stock opened at 316 and within the first 6 minutes of the day was down at 308. So you put in an $8 range right off the bat. First 10 minutes of the day, you went down to 307 for a $9 range. You look throughout the course of the day, Amazon gave a good move here to the downside and gave a nice bounce back up. Then it gave a nice steady move back down. Just a lot of nice solid movement on Amazon after experiencing a lot of range action within the first few minutes of the day. So in other words, a wide range early on in the day translated to good range throughout the entire course of the day. Then again, you look at what was Monday. Same thing on Amazon. Awesome move right away, right? Great range movement. First 10 minutes of the day, the stock opens at 304, and by 9:40, you're trading down to 292, a 12-point range within the first few minutes of the day. So based on that, even after we only see this much in price action from Amazon, okay? So even when we're just at this point in the day, we're starting to think, okay, wow, that's a lot of range right there. So based on what I know about range, or at least what I think I know about range, Amazon should then be pretty volatile the rest of the day. It should continue to make nice ranged movements. That's the thought that's starting to come into my head, very early on in the day. And then lo and behold, what do you have? Some really nice tradable moves on Amazon. You bounced from 290 up to 298, 296, Then you traded back down from 298 back down to 290, 289, and then you traded again back higher from 290 back up to 296. So just 3 awesome 6-point moves from Amazon following that really good range action the first few minutes of the day. So remember what I've just showed you now from Monday and Friday. Now let's fast forward to yesterday and compare. So we had a 9-point range first few minutes of the day on Friday, and then a 12-point range first few minutes of the day on Monday. Look what you have here though from Tuesday's price action. Amazon opens up around 297, and legit the first 10, 20 minutes of the day, there is a major limitation on the range. It comes in greatly. You go from, a 12-point range at the open on Monday to now you're trading 298 down to 294, 295 or so. You're in a 4 to 5 point range at Tuesday's open. So based on that, I would be thinking to myself, all right, range has come in quite a lot, so Amazon's probably not going to offer as many tradable moves as it did on Monday and Friday. And that was the case. There was really just one primary move. Now, this was certainly a tradable move up, but, would you rather have one good move to trade, or would you rather have multiple good moves to trade? Yesterday, Amazon really only offered one good move to trade, and that was this bottom from 10:30 to 12 o'clock, whereas Friday and Monday, it offered multiple moves to trade. And again, your range was much tighter, okay? So that translated to less range overall on the day. And then today, it really came in and showed you what you needed to see in terms of, when the range is going to be very tight. You look at today's price action. Right off the bat, Amazon trades from 298 on the low to 301 or so. So about a 3 to 4 point range, first 5 minutes, 10 minutes, 30 minutes of the day. So, and you guys know I was saying this on Amazon and a lot of the portion of the day today. As soon as you see this show up, just this super tight range, you've got to be thinking to yourself, all right, well, this probably isn't going to translate well to good range on the day from Amazon because it's showing very tight range right now. So maybe it's likely that it just kind of continues that throughout the entire course of the day. And as the day went on, you can see from Amazon just, awful trading for directional traders compared to what it offered the last few days, specifically on Friday and Monday. There's really not a move here. There's this move here, but even in that move, you went from 299 up to 302 or so. Aside from that, you were sideways for an extremely long portion of the day. When you finally did break high day, you only moved up $1. So, I don't really want to trade that. So that's an example of range. Also, let's look at Netflix for an example. Netflix from April 24th is what I want to show you guys. All right, so here you are on Netflix. So this is the open of April 24th. Right here. This is your opening price action. So right away the stock opens up, goes up, opens around 350, 353, runs up to 356, but then within 5-10 minutes this thing is back at 350. So nice range on Netflix right away at the outset. So that tells me as soon as I see that, all right, volatility here. I want to play that. There's probably going to be good range on the day if the first 5 to 10 minutes are any indication of what's going to happen next. And as you can see from Netflix, good range first 10 minutes translated to just an awesome range move. The next 45 minutes to an hour, Netflix went from 348 down to 346, and then just an awesome move back higher as well, 335 to 344, and then another one from 338 to 348, and then a decent leg lower from 346 to 340. So, lots of tradable opportunities on Netflix, and it showed you within the first few minutes of the day on the 24th that it was going to offer a lot of movement and a lot of good range. Now you compare that to today. How is it different? Well, here's our open, right? Here's our opening price action. Not a lot of range from Netflix. You opened near 320, you went down to 316, you're just trading in between that range pretty much first 15, 20 minutes of the day. So at this point I'm thinking, all right, Netflix probably isn't going to have much range today. Probably not going to be many windows of opportunity. And you can see that was for sure the case. Yeah, you had some moves, but nothing like the movement from the 24th, the example I just showed you. It played out much more slowly, and it was just tighter range action overall. You can see you went from 316 down to 312 or so, 311, played out over a course of a couple hours. In the example I just showed you, Netflix dropped 12 points and then 8 points, within the course of 60 minutes. The best move on Netflix was this rally here today off of the 312 area back up towards 320. Still though, that's an 8-point bounce that took 4 hours to make. We just looked at an example where Netflix was able to bounce 8 points with, in under an hour. So another example where a tighter range early on shows you a tighter ranged opportunities throughout the day. Wider range early on indicated wider range opportunities throughout the day. So that's number 2. First one was speed, second one was range. All right, now the third one, extension. Extension, meaning when we put in a range, what does an attempt to get out of that range look like? When a stock makes an attempt, on the daily or 15-minute sequence, 60-minute sequence, whatever, whenever it's trying to break out and move out of that range, what does the subsequent price action look like? So let's stick with Amazon and Netflix here for examples. So looking at Amazon today, so here's your range on the day, right? And we know today was a tight range day. All right, so we've got this high up here around 303. So what I'm thinking about in terms of extension is, what does Amazon's price action look like when it tries to break out at 303? All right, well, you can see you finally got up near 303 going on after 2 o'clock. And what did it look like? Well, it looked pretty piss poor. It got up near 303, but it couldn't break out. How come it wasn't able to just clear 303 and start running? All right. When I see this action here, when I see the struggle at 303, the inability to extend out of the range, then I'm not optimistic from a trading opportunity perspective. And then, lo and behold, when you do finally break out above 303, just ahead of 3 o'clock, you're only able to move $1. The move doesn't end up getting sustained, and you come right back down beneath that level. All right, so that is an example of a lack of extension. Now let's look at an example of good extension. Again, going back to Netflix from 424, or no, here we are. 428. All right, so Netflix gets established in a range, first couple hours of the day. All right, we've got our low is at right around 308. So notice when Netflix starts to approach 308, notice unlike the Amazon example I just showed you, it's able to move right below it right away. It doesn't, really hesitate at all. It makes a nice clean move down to 308 and is just cracks below low a day and then continues. And notice how that resulted in further pressure, from 308 down to 302, and then from 306 on a bounce back down to 300. So that was an example of a good clean break below the range where you were able to extend lower. So I would want to be trading that. I would be short biased on that. You had the same thing from Netflix on the 25th. So your low gets established the first few minutes of the day. You come down to it right here. You don't hesitate going below it. You're able to just flush right through it, and you make a nice move down from 334 down to 328. Then again, you have this low here. You come down to it, and you just go right below it, and you get another leg down from 326 down towards 324. So those are examples of, good range extension where you're breaking down and you're not hesitating on the breakdown. You're extending the range right away, unlike the Amazon example that I started out with. Oh, there's one other example, another good example of a bad breakdown from Amazon from the day it reported earnings. So here's your low that gets established. All right. Notice on this, yeah, you break below the low at first, but then you come back up right away. You're able to come back above it, unlike the previous two examples I just showed you. You didn't extend lower, so that right there, that's a bad sign from a trading perspective. Okay, so I'm not betting on a bigger move. And then on the next low a day test, I don't want to get suckered in to buying puts at the low a day break because it already showed me when it broke to a new low a day, it didn't continue to extend lower. And sure enough, if you just stretch it out here and look at it, you can see the exact same thing. This low that got established ahead of 10:30, when it then got tested between 12:30 and 1:30, you can see how poor the reactions were to the downside. And each time it was able to kind of come back up. Now, you take all those things and you kind of put them together. The speed of the level 2, and the speed of the tape. You want to be watching that as the range is either extending or not extending. And by using all those combinations of analysis, you can determine, is there good volatility or is there low volatility? If there's good volatility, chance of a big move, you want to play out of the money. And if there isn't, then you want to be closer to the money. And that's exactly right. Big range days, gamma will accelerate as the delta moves through the strike zones, so you're going to benefit from being out of the money. But if you're on tight range days, then that's going to work against you. Any questions about that? And again, look at the film. Today and yesterday, perfect examples of when you want to be in the money. Perfect examples of when it pays to be in the money. Monday, Thursday, Friday, last week, good examples of when it pays to be out of the money. Next question isn't anything that involves examples. It's more of a lifestyle question asking, what is my morning routine from the time I wake up to the time I go live and start my trading day with you guys? So first of all, I wake up at the same time every day, 6:33. Don't ask me why it's 6:33. That's Central Time, by the way, so 7:33 Eastern Time. I'm in Chicago. And the first thing I do is I check what my 6 primary stocks and futures are doing. I check it from my phone. I don't turn on the computer yet at that time, just to see if there's any significant gaps in either direction. And what you should also know is that my phone is outside of my bedroom. It is in the kitchen. I will not allow my phone to be near me when I sleep. When I'm sleeping, it's all about sleep. My sleep really affects the morning routine. Had to include that. All right, so then after that, after I check things out, see if there's anything significant going on, I stretch out for 5-10 minutes. I've got a little yoga mat in my living room just to kind of get some blood flowing. You know, I do a lot of sitting down in the day, and you guys probably do too, so I think it's good to stretch out, get the blood flowing, and just help myself wake up. And then I go on my iPad and check out charts, daily charts of my 6 primary stocks. Only my 6 primary stocks. I don't want to get distracted looking at something that I'm not planning on trading anyway. And by that time it's about 6:50, and I usually lay back down or sit down with my iPad and watch film, live trading footage from either the previous day or, you know, a day last week that I wanted to watch, or just a particular trade I wanted to review and see how I executed or didn't execute and what I could have done better. I like watching film each morning because it just kind of helps get me in the zone. So then around 7:20, I turn on my platform and just make sure everything's up and running smoothly, write down some prices, see where things are at so I can track net change later on. And around 7:30, I make a smoothie. Every day I make a smoothie, different smoothie recipe, but always a smoothie. And then just before I go live, I have a little pep talk with myself in the mirror. Just, you know, maybe something I want to focus on for that day. You know, maybe come with confidence, stay calm, you know, whatever it is. Just kind of have a little self-talk with myself, and to really help me get zoned in and focused, pumped up, if you will, whatever you want to call it. But I have that talk and just make sure that my head is ready to go. And then I sit down with you all and get going. What I do not do, I don't check anything that doesn't have to do with my primary stocks or the market. I don't go on Twitter. I don't go on Facebook. I don't check sports headlines. I don't read news. I don't answer emails. Nothing. I don't want any distractions at all. So if it doesn't have to do with Tesla, Netflix, Amazon, Google, Priceline, Apple, or the futures, then don't tell me about it. And I'm not going to look for it, because there's no way I'm going to allow myself to get distracted. And that's something I used to do. I used to, you know, I always want to see what the sports score was from the night before or something like that. But, you know, only bad things can happen if you're not being as focused as you possibly can be. So that's what that is about. My only advice, I'm not going to tell anybody what to do in their morning, but wake up, you know, with a full 45 minutes at least before the market opens. Don't be one of those guys that's rolling out of bed and getting on the computer and the market's opening 10 or 15 minutes later. Just don't do it. Treat this seriously. You know, there's money on the line. You need to invest in yourself, and that starts with waking up early and being alert and ready to go. Don't be a bedtime trader, as I call it. Any questions on that, on my routine? And don't be afraid to talk to yourself either. I think talking to yourself is very underrated when it comes to trying to accomplish something, whether it's trading or, you know, anything. It goes a long way. Okay, now the final question I received was relative to our setups. And the question is, I want to understand, how do you set up your reference point price for tomorrow's trade? Are you picking closing prices as a setup for reference points for entering a call or a put? For example, coming into today on Netflix, the close was $319.87 and your over-under reference point was 320. So is that saying if it goes above 320 at the opening, you would take a call, and if it goes below 320 at the opening, you would take a put? Also, for your support and resistances, are you looking at the last 5 days or 3 days, and are you using a 15-minute chart? Well, the first thing I wanted to mention is that a very similar question was asked in last week's webinar, so I'm going to refer you to that at first, and I am getting the link for you now so you can watch that. This was the April 23rd webinar. I just posted it. I posted the link in the GoToWebinar page, and the question that was just asked is very familiar to question number 2 from that webinar, where I explain the thought process behind over-under setups. That is at the 20-minute and 2-second mark. So watch that video, because that will be very helpful to you in addition to what I'm about to say now. So as far as how do I pick the point, the reference point I'm talking about in this example, 320, I'm choosing the round level, which usually ends in a 5 or a 0, that is closest to the previous day's closing price. And yes, the thinking is that if the stock moves above that round level, then I can trade it long using that level as a stop loss. And if the stock moves below that round level or stays below that round level, in Netflix's case today, then I can trade it short using that level as a stop loss on the short side. So sticking with that Netflix example that you cited in your question, the setup was on 320 today. Why 320? Well, yesterday's close was 319.87, so 320 is just kind of the nearest level. I don't want to pick a random number, 318, 319, 317. Those are what I refer to as no man's land numbers. They don't have any psychological impact to me. You think about marketing and products when they're sold. People don't sell things for $318 or $317. They sell it for $300, $320, $325, $350, or they sell it for $5 or $10. They're not selling it for $9. And in most cases, obviously you should know what I mean. All right, so Netflix 320 was where you had a round level reference point to trade with. So over under 320, you can see today Netflix opened up, but it was holding below 320. You look at this action here, and then again here, Netflix was staying below 320. So in that scenario, you can see that it opened and stayed below 320 at the open. So your setup is shorting Netflix since it's staying below 320, and then you can see that the stock made a nice leg down from 320, 318 area down to 312, 313. So for tomorrow, a couple reference point setups here. You've got Google. Look at where Google closed. right on 535, right? You see all this action around 535. So tomorrow, my setup is if Google's able to hold above 535, then I'm going to go long Google and use 535 for a stop loss on that call trade because I'll be buying calls if I'm long. Or if Google is holding below 535, similar to the way Netflix held below 320 today, then I would be short Google where I can use 535 as a stop loss. The main point behind my reference points is I want to make sure that when I'm entering a trade, I'm thinking offensively, but I'm also thinking defensively. I'm thinking offensively from the perspective that, all right, here's a round level. Where's the next round level? Well, 535. The next round level is 540 to the upside or 530 to the downside. So offensively, if I'm getting in on 535 holds, I've got a nice 5 points worth of upside that I'm going to be able to trade. On the short side, I've got a nice 5 points worth of downside that I'm going to be able to trade down to 530. That's my offensive mindset. But defensively, okay, and probably more importantly, offense wins games, defense wins championships. I know that my stop loss is close by, so I can get out and keep my losses small. Okay, if Google is holding 535 and it looks like it's setting up to be a long trade, I can get in on 535, maybe 536, and if it goes down $1, I'm stopping myself out and I have a small loss. Or on the short side, if it's staying below 535, I can short it, but then if it starts to spike above 535, I can get out and I have a small loss. And I did this today. I did an okay job of it. If you look at my orders, you'll see that I bought a Google call and I'm showing you the good example because one of them I didn't do good. So I bought it at 220. Okay, so let's examine that entry when I bought calls at 220 today on Google. Let's look at this. At 220 is this candle right here. This is the action that I bought calls on Google. Why am I buying calls there? Well, look at where I am. I'm at around level 530. So in that scenario, I have an over under 530 setup, and I'm liking the way that every time it comes below 530 here, it keeps being able to get back above it. So I can say to myself, all right, as long as it's holding 530, I can be long and I can trade Google long versus that level for a very low risk trade. And I ended up selling at 250 from 260. I lost 10 cents. I didn't like it was this candle here, I believe. I ended up getting shaken out. But still, even though I got shaken out, I still played defense. All right. And, I still had myself in a position where if it did continue lower, I had gotten in at a good price close to a reference point where I knew I would be stopping out if I didn't like the action around that reference point, and the result is just a small loss, and it's very important to keep those small losses. Now, one thing to be aware of, and I did this today, is sometimes I do the opposite trade. For instance, Amazon. And again, I did this trade exactly today. So Amazon, my over-under today was 300. The over 300 is looking for upside. The under 300 is looking for downside. However, today it went above 300 and I still shorted it. All right. And the reason I do that is because sometimes I have a core belief that the stock is moving in a certain direction. And by shorting it just above that round level, I can essentially enter a very low risk trade, because if I am wrong, I'm going to find out very soon and take a small loss. But if I am right, I could end up getting the very top for a short trade. So Amazon today, here's 300. So this line in the sand is your over-under reference point. Amazon made this spike above 300, but I still decided to short it. Why did I do that? Well, I had a core belief that Amazon was under pressure on a day-to-day basis and was still going to trend lower. And while it's above 300, in my head I'm thinking, all right, dude, you can short it here on these 300s, and if it's able to move through 300 or able to hold it, you can stop out at a very small percentage loss. But if you're right that this is a fake out above 300 and this is the high of day, you can have exponential percentage returns to the upside. Now, I did end up being right in that moment, but it wasn't a very good move down at all. It was pretty much just a wash on the trade. But the point remains, sometimes you will see me do this where if a stock comes above the round level, in this example, in a different example, it might be if it's coming below the round level, I could still stick with a short trade even though the rule says, hey, it came above 300, so you should be long. And the way to summarize this point is with this statement. My risk is the lowest when my trade thesis is most likely about to be proven wrong. My risk is the lowest when my trade thesis is most likely about to be proven wrong. But again, watch that video I sent in, as that will really go a long way in giving you a further explanation to this question, and it'll be very helpful to you. Any questions about that? Does everybody understand that point, that final statement that I make about my risk being lowest when my trade thesis is most likely about to be proven wrong? That is a psychological concept that took a long time for me to realize. But I feel that now that I have realized it, I've been able to pull off some really sick entries in some cases. So Pals is kind of confused on it. Okay, some of you other guys are confused by it too. All right, let me think of a better way to explain this. Basically what I'm saying is that there's a 99.9% chance you're going to be wrong, okay? When, for instance, in this case with Amazon, I said today, going into today, if Amazon's getting stability above $300, then, you know, it's a long setup. But yet, I still shorted it when it moved above $300. And to me, as far as risk goes, you know, risk is defined, in my opinion, by how much money you are going to lose if you have to take a loss, you know, whether in dollar terms or percentage terms. So the smallest possible loss means the smallest possible risk, the way I see it. So when Amazon's above 300, I know in my head I can short it, and if it goes any further, I'm getting out. I'm getting out. I'm done. And if I do get out in that type of situation, since I shorted it maybe when I, by the rules, wasn't supposed to, my loss is going to be very, very small because I'm essentially buying it very close to where I'm going to sell it if it continues higher. Meanwhile, if it does stall out on 300 and comes back down, I've essentially shorted it at the high of day. It just has to do with being able to identify, hey, I've been saying this all along. I've been saying that Amazon's going to 290 all along, right? And now it's looking like it's maybe not going to 290 anymore. I'm about to find out whether it's going there or for sure not going there based on whatever happens in the next 60 to 120 seconds around this 300 level. So therefore, I can enter a short trade here, and since I know that I'm going to find out what's going to happen very, very soon, and I know how I'm prepared to react to that, I can get out with a small loss if it fully takes that 290 target off the table. For those of you who are confused by what I'm saying, what part is confusing you? I know it's kind of, I mean, like I said, it took me some time to start to understand it myself. Yeah, okay, cool. I'm just trying to make the point that when you know for sure if something happens next is going to make your whole idea wrong, then that's when you have a really low risk window, because you can enter, and if you get proven wrong in the next 60 seconds, boom, you're out. Now the key with that type of thinking is you need to be disciplined and you need to act on it. You know, when I shorted above 300, knowing that, hey, Kev, if it moves any further here, you're kind of screwed, bro. You better get the hell out. I can't be staying in then if Amazon starts printing 301s and 302s, and I can't be finding an excuse to be like, no, well, I think it's still going to come back down. All right, so that's the other element to it. All right, that wraps it up for the questions. Is there any confusion about anything, any clarification, anything people want to go back over before I move on to the 3 chart requests that I have? And just a topic on that last question, guys, if you go back and you watch April 23rd's video, I'll try and get it up here. Okay, yeah. Just so you know, my web guy he had a personal matter, so these videos haven't gotten uploaded, but they will this weekend. He'll be back. All right, but go watch April 23rd's video. I posted it in GoToWebinar just now, and I'll post it in the chat room in just a second. But April 23rd's live trading video is a great example of that last point I just talked about, relative to entering a trade when, you know, the whole idea behind the trade is about to be proved wrong. It was on Netflix. I shorted Netflix, you know, when the average person probably wouldn't short Netflix. I shorted it because I felt that, hey, if it goes any higher right here, then I know for sure it's not a short anymore. And it ended up being the high of day, and if you looked at the time and sales from that day, my entry I think was 240. The low of day on that put was like 235 or something. And it's like, you ever wonder who's buying at the who's buying puts at the exact top? Well, it's the people that are shorting it, you know, when most people think that it's not a short trade anymore. That person probably doesn't think it's a short trade anymore either, but they think there's a very small chance that it still is. And if it is, they're going to bank, but if they're wrong, they're going to get out right away. So their risk window is very low. All right, watch the video. It shows up. The trade I'm talking about shows up within the first legit like 5 minutes of the day, 5 to 10 minutes of the day. So you don't need to watch much of it. If you just watch the first 15 minutes, you'll see the trade exactly that I'm talking about, and that will really go a long way, I think, in that statement that I just said about my risk being the lowest when my trade thesis is the most likely about to be proven wrong. It'll help that statement make sense to you and get a better understanding of it. So do me a favor and watch that. That's how you guys know I watch film, man. I can just tell you exactly when that shit happened. You really got to be in tune with your trades. All right, so chart requests. First one I received was on Plug. Sub $10 stock. Pretty epic move by Plug here. Went from $3 up to $11, but has since pulled back and been under some tough times. But if you look, you're around $4. That was yesterday's low, and that's kind of where the move stopped at the beginning of the year. You got up to $4 from, under $1 really. The rally started way back in November, October. You rallied, but you stalled out between $4 and $5 and traded back down to $2. You put in a low in late January, and then you rallied again, though, and had a brief consolidation right around $4, and then it was this candle here on the first trading day of March and you broke out above $5, and that's really what sparked the major momentum move. So you've pulled back now to where that big time move started. So I actually kind of like Plug here for a little risk and reward setup in this $4 to $5 range that it's consolidated the last couple of days. And I think as long as you hold $4, then there is upside back towards the $6 to $7 range. You maybe don't want to buy it right here, $4.65. It's kind of no man's land. $4.50 would be a reference point. Or if you're able to spike above $5 and hold $5, that's a better long setup. However, if you struggle to hold $5 and you're pressuring $4, then maybe wait and see. Make sure that it's holding $4, because if you were to lose $4 from Plug, then you can go back down towards these areas here, which was $3 and below. So this $4 to $5 action is really key. What's the next move? Is it able to get stability above 5, or does it go back down and test $4? Line in the sand on the long trade is that $4 mark. Any chance of upside has to have Plug holding $4. Overall, though, more longer term perspective, if you look at a weekly chart, you'll see that Plug had huge volume come into the stock after just nothing to speak of for years and years. So I like that, because I feel that, this volume kind of comes in for a reason. Even though the stock got whipped around a bunch, there's a lot of money that came in there. So if it can hold up on the charts, there's interest. There's interest because the money tells you there's interest. So longer term, Plug is one to maybe keep an eye on. But as far as upside, it really needs to be holding that $4 mark. Then looking at, I'll do that one last. Looking at Alcoa, stock AA. So Alcoa's been on a nice uptrend here to start the year. You can see, and what I like about this Alcoa is it's been moving higher at a time when the market has been moving lower. You can see it's in this channel here that it broke out briefly above. So I like Alcoa, a lot really, because it seems to have some relative strength. It got a nice clean move above the psychological $10 level on back at the beginning of the year. You had a gap down, and this was the real tell by Alcoa. All right, look at this gap down right at the beginning of the year, right around 10 bucks. And then boom, straight buying, no questions asked, no decision making, or no indecision about, hey, should it go lower first? What's going to go on at 10 bucks? Nope, market didn't care. Market took this thing straight back up, and it was making new highs within a week. That was a great sign. That was the market telling you that, hey, we've got serious buyers here, and this is a major buying opportunity, and we're not just going to stop buying. We're going to keep buying this thing on up. And then once you got above it, you then held that level, that previous high, then acted as support. So previous resistance turned into support. And then you had a high around the $12, $12.50 area. Okay, you were kind of topping out, stalling out somewhat, but then you broke above that when you broke out right here, and then you pulled back. But again, then look where you held. Previous resistance turned into new support, and it's just been textbook along the way. So Alcoa is in a nice steady uptrend here, and you've got this most recent low, which is just above $13. I think you can trade Alcoa on the long side as long as it's holding 13. Then the immediate term trend is higher. The intermediate term trend, though, really just needs to be steady above 12.50 or so. That was the high from the beginning of the year. You don't want to get below 12.50 in the intermediate term, otherwise that kind of negates things. From the longer term perspective, though, it's just all about now staying steady, above $10 to $11. These lows here from March are key lows on Alcoa longer term for the trend. I'll show you the long-term chart. You can see that this is a stock that was in the cellar for a really long time. Okay, Alcoa was a big-time poster for the recession. All right, you can see that this, you're looking at a monthly chart. Alcoa went from $10 in the 90s up to $45 in the 2000s, but then Mr. Recession came along and huge move down from from 45 back down to below 10, and really for the last 4 years Alcoa has not participated with the market. Alcoa put in a low. Its 2009 low was $5, and then just in 2012 Alcoa was down near $8, and just last year it was at $8. So, for a long time Alcoa did not participate in this monstrous market rally, but now the market has kind of stalled out, and you can see Alcoa has a nice monthly winning streak going for it, and it's really started to rally from $8 in 2013 to $13 now. You're talking about a rally of over 60%. So I like AA a lot as long as it holds that, $11 area longer term. Longer term, I don't want to be dealing with $10. That's a nice psychological level that somebody else might tell you is more important. But from my perspective, I'd be saying, well, let's be done with 10 at this point, because if you get back down to 10, you're talking about a 30% drop from these prices. You don't want that. Immediate term trade, though, hold $13, and I see 15 acting as a magnet, and I see potential for Alcoa to get to 20 overall this year. Lastly, looking at Twitter. Twitter IPO last year, so not a ton of chart history. Earnings reaction today, you can see stock went down to a new all-time low. $40, guys, nice, simple, easy level. 40 has been the floor in its short history a couple of times, but that floor gave out. So now we are in the basement, so to say. So let's see if that previous floor at 40 starts acting as a ceiling. Twitter is extremely bearish if it can't regain 40. If it can regain 40, then you have a potential bottom, but it would really need to hold 40 and start pushing back up near 45, challenge that high from yesterday, which was right around 44, 45 bucks on 40 holds, but it's just all about getting back above 40. If this thing does not get above 40, it is an outright short, and it's going to $35 to $30 over the next 6 months. That's just the bottom line. So really simple trade set up here on Twitter, which is nice. Just key in on that $40 level. You get above 40, you can have some good upside bounce potential to 45 to 50. All right, guys, that wraps it up. Are there any questions? I have a question for you guys. Do you prefer this time slot, 8:30 p.m. Eastern, as opposed to last week we went with 7 p.m. Eastern? All right, so a couple like this time better, some like 7. I'm in Chicago, so I'm pretty flexible. East Coast, it starts getting late, much past 8:30, 9 o'clock. West Coast, if it's before 8 o'clock, it's kind of a little too early. So maybe we'll just kind of keep rotating, take it on a week-to-week basis. But getting into a good groove here, going to continue to be Wednesday nights.